So what is a profit and loss? How can it help you run your business? How can it share you insights so you can make good commercial decisions? And how can you showcase it to get fundraising from investors or banks? Hi, my name is Alysha Randall. I am a portfolio CFO for Fast Growth Consulting, and I also train both founders and financial professionals on being a CFO and understanding financials. So today I wanted to have a really good look at a P&L or a profit and loss or income statement. So I did a high-level overview of the 3 financial statements, which I'll link below. But today I just want to look at the profit and loss statement. So it can show you quite a lot, but obviously you need either your bookkeeper or your finance team to help you make it more interesting. Okay, so here is a basic profit and loss. This is quite similar to something that you would see through your general ledger. So if you're exporting, you haven't made any customizations, and you're just exporting a profit and loss statement from your general ledger, be it QuickBooks or Xero or what have you, then it would look something like this. So you have your different types of revenue. Sometimes you might just have total revenue because you haven't put in different revenue elements. You have your direct costs that have been classified as such. And then you'll have your a list of expenses. And generally, the list of expenses can be quite long, but I've just summarized them for here. So what is it telling me? Is it interesting? How can we change it? What am I supposed to do with this? So the first thing I would focus on is revenue. So at the moment, I have included here 2 different types of revenue. Other revenue, which is generally, say, interest that you get from the bank or little bits and pieces that you don't get regularly. And then in this example, I've got subscription revenue, but it could be anything. It could be, whether you're selling to on a website and it's just product sales, or it could be services, so consulting services, anything that you are selling essentially. And ideally, how you want to think about this is categorizing all of your different revenue streams. So again, if you've got Xero or QuickBooks or something like this, they usually have 1 or 2 revenue and everything just gets chucked into that one bucket. This doesn't help anyone. So ideally what you want to do is you want to think about all the different types of products you offer and categorizing them. So whether it is a different product, whether it is a different customer type, whether it is you have, say, your core product. So say, for example, you do subscriptions and everyone pays a monthly fee, but then you have add-ons. So they could upgrade here or they could upgrade there, or you have different types of subscriptions. So I would strongly encourage you to think about how you talk about the business to your founders, your investors, your internal team, and how you think about your product offering. And then categorize your revenue exactly the same way. So then you can see exactly how much money you're getting or how much revenue you're getting from each of these different product types. So it's really important taking a step back and thinking about that. Generally, I think about core product. So what is my main product offering? And you have that. Maybe you'd have, say, I'll go back to a subscription. Say you have a basic subscription, and then you have say a premium subscription, and they're like your 2 offerings. Or you have, your 3 different consulting offerings, or you have, say, your GMV, so your sales, essentially, your revenue from GMV, basically. So you have your core product offering, And then you could have your additional services. So this is when you're upgrading. So whether, it's an upgrade or an add-on, or, it might be, say, shipping revenue, for example, or advertising revenue, or affiliate revenue, all these different types of things. And then you would have your other revenue, which is very, miscellaneous and ad hoc things. So that is a very typical way that I would want to see revenue for a high-performing finance team, and also to understand the business. So then you can really see what's going on. On top of that, I would say that is your gross revenue, and then you would have refunds, and then you'd have your net revenue. So as well as for a fundraiser as well, or an investor rather, potential investor, they would be very interested in how you do your revenue, particularly in this part, because they're interested in what is recurring, what is sticky, what are you going to get all the time? Is this fairly consistent month on month? So it's very important to really think about what is your baseline, what is your core product, and then what do you kind of add on top of that. The next section then is your cost of sales. So revenue is very easy to understand. It's the money that you get for your business. It's quite straightforward. This is cost of sales is when it can get a little bit more complicated, because what is the definition of a cost of sales compared to your other expenses? Well, essentially, it is the cost that you have to pay for every single time you have any revenue. So it's easy to think about that with a product. So say, for example, you're selling a dress online, and the consumer is paying $150 for that. But it costs you, the cost of your cost of sales for that, cost of sales is, you have, say, for example, it costs you $50 to actually produce the dress or buy the dress from a wholesaler. And then it might cost you another $10 to ship let's make it a bit higher. So, and then it costs you another $75 or pounds to buy it. So that's actually the product. That's how much it costs you. And then say it costs another 10 in shipping and packaging. And then say it costs you another 10 in actually pick and pack. So getting this actual dress. So say that's internally or externally. So someone buys a dress, you have to have that product available to sell. That's the cost of your product. You have to send the product to them, and you need a team, whether it's in-house or a third party, to get the dress off the shelf, put it in the package, put the label on, and stick it in the mail. So these are all your cost of sales. You cannot fulfill the customer's requirement without these costs. Another way of thinking about it is, every single time you sell a dress, this has to happen. So it increases in line with your revenue. So say, for example, you sell 10 dresses, then you're going to make £1,500. But similarly, the costs are going to increase in line with your revenue. So it's a direct cost. Hopefully that makes sense. And then these costs can be variable or fixed, and I'll go through that separately. Now, when I'm thinking about, again, making a P&L interesting for you and for investors and for the board, and to help you make commercial decisions, essentially you want your direct costs to be split the same way as your revenue. And I'm going to change this to core product, product A, product B. And then I'm going to add just additional services. So ideally, you would want your cost of sales to be the same. So within product A, you may have all of these elements, but your subtotal, it all totals up to product A. Similarly here. The reason why I would encourage you to think about your P&L like this is because, say, for example, you had product A, well, that's quite the, particularly for retail. So say, for example, you had something like this, and then you had, I don't know, 500. Here, for example, you've got product A made 100,000, product B of your core product made 25,000, and then your additional services made 2.5. And then within product A, you had all of the elements that are directly, you know, the cost of sales that are directly attributable to product A within this total. So this is a subtotal. And then B and additional services. Now, the reason why I encourage that is because the next step of cost of sales is gross profit and gross margin. So what we are saying here is gross margin. What we are saying here is the total revenue minus your direct costs is 57,000 in this instance, and then which is 45%. So we're saying every pound or dollar that you sell, 45 cents or pence stays with the company. So 55 cents of every dollar goes out of the company. That's your cost. And ideally, you would want this 45% to remain relatively consistent month on month. And ideally, as you can imagine, increase over time. So if you had, say you had month 1, month 2, month 3, if you are looking at your P&L and you have, say, 55% here, 25% here, and then 75% here, if you are seeing that, I would really question the way you're accounting for your revenue and cost of sales. If you find this, I would go back to your bookkeeper, back to your accounting team and say, this needs to be consistent. Because if I'm selling one dress, there is one cost, and the cost is the same month on month. It's not different. So what might be happening is they may be putting one dress here, in this instance, one dress here and one dress here, and then one dress here and 3 dresses here, the costs, and one dress revenue and 0 cost. So it's not consistent. And this is what an accountant should be doing. They should be making sure that the costs here are associated directly with the revenue here. The recognition of the cost and revenue need to be the same. You can't sell a dress here and then have a cost of 3 dresses here. Or you can't have a cost, you know, a revenue of 1 dress here and then the cost of it 2 months later. So it really needs to be directly attributable. And this is why gross margin is interesting on 2 levels. Firstly is understanding the profitability of the company and making sure from an accounting perspective and an investor that this is consistent. I have done due diligence for VCs before, and we've seen gross margins like this. The investor didn't trust the numbers and the deal was starting to go sour. So instead, you want it to be consistent. And when I say consistent, I mean like this is still consistent. That's fine. That's fine. There's always nuances. So if your gross margin is looking like this, and it's roughly the same, maybe 2%, depending on it, on the materiality of it, it's not too bad. But you certainly don't want your gross margin looking like this. Now, ideally, your job as a founder and your operations team, I'm going to change this to year 1, year 2, year 3. Ideally, whoopsie, year 3. Ideally, you want your margins year on year to look like this. So, and your budget as well, your forecast, you want your gross margins to look like this. And you want to have a reason as a business as to why that is. So it could be we are selling so many dresses that we are getting a better rate when we purchase them. Or we have decided to bring delivery in-house and it's actually cheaper than a third party. Or we have switched 3PL and the company that is delivering our dresses are much cheaper than the last one. So these would be perfect examples. Oh, actually, I've done it the wrong way around. Oh dear. Hopefully you picked up on that. If not, that's fine. So ideally you want your gross margin looking like this. You want more money staying in the company. If it's going the other way around, which we are finding at the moment, this is February 2024. We've just had a year of cost of living crisis. So you may find that it's the same as what I had previously, which is looking, which was looking like the other one, is decreasing. You might find that you're doing that. And it may be because delivery has increased, the cost of packaging, the cost of your product has increased, and this is the situation. But obviously that is something that you really then need to work towards. Now, going back to the split of the different products, the reason why I like this to be the same as this, again, you'll have many elements. This is a subtotal. The reason why I like this is because you can then get the gross margin of each individual product. So in this instance, we can see that your product A, your main core offerings, margin is significantly lower than product B and your additional services. So then you can ask the business and work with the business, do we need to push product B? Is product B a better offering for the customer? And it's certainly a better offering as far as the business is concerned because it's got much higher margins. I mean, obviously this is quite extreme. It's probably not usually this extreme, but it is a way of looking at all of your different product offerings and deciding, or service offerings, and deciding which one makes you more money and which ones should you push. And this is why having a much more detailed revenue and cost of sales is so important for SMEs. Well, all businesses really, but particularly SMEs as you're trying to understand the business. So that is the top half of the P&L. Then we have got your expenses. So the first one is your marketing costs, and then all of these kind of costs you understand. They're quite straightforward. There's nothing too crazy in there. But I will go through another way of thinking about your P&L. And that is creating another subtotal within your P&L. And the reason for doing this is because, particularly when you're trying to understand the business, having a separate line item, I'll go through this in a second. So having your selling costs and your marketing costs, contribution, profit or loss, particularly for a startup or scale up, is really important. So basically, we're thinking about, so we'll get rid of that. We don't want it duplicated. So we're thinking about what other costs are essentially variable that you can dial up or dial down. And that's these costs within reason. So these costs are variable, as in they do change month on month, but you have control over them. So for example, going back to that dress example, if you sell a dress in month one, you have to pay for that dress to get to the customer regardless. Like, otherwise you're going to get a refund request. However, the amount you spend on selling and marketing, you have full control over. So you can turn on the taps or turn it off. But it's also quite variable. So in general, if you have more revenue, your sales and marketing costs will also increase in general, because you need to spend more money on sales and marketing to get higher revenue. So that kind of makes sense. So this is why I like to split these out from your general expenses, because it gives you more information and it helps you understand, where things are going. And it also helps you understand, again, around profitability, CAC, and LTV, lifetime value, which I will go through. So it's also another way of presenting to fundraisers. So what's quite common for particularly early stage startups and scale ups is you may see a situation. I'm just going to pause while I put money in. Okay, so contribution margin, just so that you know, is your gross profit, which is revenue minus direct cost of sales, minus your sales and marketing costs. And then your contribution margin is your contribution profit or loss divided by revenue. Now, this is very, very common for a new startup and scale up. Is you've got your gross margin, which ideally you want in the black. Early stage, like as in the first 6 months, it may not get to the black, but ideally you want this profitable as quickly as possible. But this one might take a little bit more time because you are trying to grow brand awareness. You are trying to get your new customers who then become repeat customers. And obviously when you have repeat customers, you don't have to spend marketing to get them to come back. Not much anyway. And so it's very common for the first few years, couple of years of a business, particularly one that is in the fast growth area and has investment, you will see this situation. Not always. You may decide that, that's not for me, and I only want to spend a little bit on sales and marketing because I want to grow organically and I want to keep some profitability. So either is fine, but it is a strategic decision as to whether you want to grow as fast as you can, which was very much pre-2023 or 2022 even way of thinking. So get investment through the door, get a product that has gross margin, and then with your investment, just grow, and spend loads of money here. Or nowadays, people are trying to remain or get to road to break even as fast as possible. So there is less money spent here and you have a contribution profit and therefore contribution margin. So this is a strategic decision, and therefore having this part broken out makes it much easier for you as a founder and your leadership team and maybe not the board necessarily because it's more operational, to make a decision of what strategy you're going to go with. So the other thing worth being mindful of this is also having this separate helps you with your CAC calculation. So your CAC calculation is how much did I spend on sales and marketing and how many new customers and new revenue did I get from that? One divided by the other gives you your CAC. And so you can see how efficient your marketing is. So if you're spending £5,000 on marketing, what are you getting back? Or sales and marketing, what are you getting back? Next month, same question. So always looking at how efficient your marketing is, particularly over time. It's hard to do that in just month one, but particularly over time, because this is an investment. You're investing in the business to get more revenue. And this investment, is it paying off? So this is why I would send this separately. You can throw other things in here, such as customer services, because again, customer services increases as your revenue increases. You can pull it back. You don't have to. You can have, a real lean team, for example. But this is really important. And contribution, having this separated out, you know, zero and what have you, you have to do a customized P&L in order to do this. So if this is something you would like, and I would encourage you to do, well, all of this actually, I would encourage your bookkeeping firm or your in-house accounting to change their P&L. So you've got this visibility. And they should be able to do this really easily. It's just a customized P&L. Okay, and then we have your fixed costs. So staff costs, you know, your wage bill, professional fees, you know, so your external accountants, audit if you have to have, legal fees, consultants, all those kind of things. Tech costs, so often this is tech subscriptions. So if you have Salesforce or Xero or HubSpot or Gusto or, you know, all those kind of things, you can put that in here. If you're a fintech or a tech SaaS or those kind of tech-based business, you may want to put in your tech team in here because you're demonstrating how much you are investing in R&D, in the platform, in the product, and you can manage that separately. So this one could be just your like back end. So again, similarly with selling costs, this may just be a Salesforce. So you may want to split out, put your Salesforce in here. Office administration, rent, which a lot of people in startup world don't have too much of anymore. You know, just your general bit of travel expenses, these kind of things. Depreciation, if you don't know what this is, basically anything that you buy, so say you buy a computer which costs £1,500 or dollars for every single person in your company. So you will buy that £1,500. And generally, instead of just seeing this as an expense and putting it through your P&L, you would see this as an asset. It would come up in asset in your balance sheet, which I'll do next. So your computer costs you $1,500, and generally we say that this computer will last 3 years, and then you're gonna have to buy a new one. So what we do is we recognize this cost, this $1,500, over the full 3 years. So we drip feed it out over 3 years. So 3 years is 36 months. So we say 1,500 divided by 36 is 41 pounds or dollars. So this depreciation, for example, would include that $41 and all of the other assets that it's called depreciating over time. So you may do office furniture, you know, anything in generally, I'd say that costs over £500 or maybe $1,000. That's quite a common ceiling. So anything that costs less than that. So say you bought a keyboard or a mouse, you know, unless it's part of a package of a new package computer, I would just put that into here, tech costs. But if it's something significant, then you can put it on the balance sheet and just drip feed the cost over time. So that's what depreciation is. Bank interest and other costs, you know, bank fees and what have you, maybe interest. Interest I'd show separately, but we'll do that another time. But essentially, these are what you call your fixed costs, essentially. So obviously with a startup, particularly your staff costs and your tech costs, these will increase as you're building your team. You know, if you're double in size, you may need an in-house finance team, whereas previously you just had a bookkeeper outsourced. Or, you know, with tech costs, you know, you might have AWS costs, for example, or subscriptions for every single staff member, or subscriptions for every single 1,000 users, for example. And again, the bigger the company gets, the more this increases. But ideally, you come to a point where your fixed costs start slowing down. And what you want to check here, particularly when you're looking at things year on year, you want to see, okay, my revenue year on year is increasing by 50%, 100%, 300%, 20%. My direct costs potentially are increasing at the same rate, plus or minus. My marketing cost could be quite variable. Again, that's your strategic decision. But your fixed costs, ideally, you do not want these to be increasing at the same rate as your revenue year on year. You want these to slow down. So you may find in year one or year two, they're potentially increasing as fast as revenue, but then you really want them to slow down. And when you get to a certain level, keeping it at 5% is not out of control. And you may even want to reduce it. So the reason for this is because then you become more profitable. If this increases 50% year on year, and this is increasing 5% year on year, then this becomes bigger and bigger and bigger, as long as you manage your other costs. So hopefully it's given you a good overview of how a CFO and an investor would think about your P&L. Now, the other thing that's worth saying is, yes, we've looked at like the row labels here, but the other thing worth looking at is the columns. So looking at, when you're looking at your P&L, looking at the trend, month one, month two, month three, how are you comparing to the historics? Are there any trends that you need to be thinking about? But also year on year. So in January 2023 versus January 2024, and I find this particularly interesting for seasonal companies, so you're comparing the same month year on year, how are you looking? Have you got the same amount of revenue of January, or have you increased by, say, 50% January 23, January 24, but these costs have increased by 100% and therefore not as efficient? Or, or if these increase significantly more? It's really interesting to see month on month as well as year on year. And then generally you will compare this to budget. So thinking about how your current month's results compared to prior months, how it compared to the same month prior year, and how it compared to the budget. So this is where you can really get some insights into your business and understand how you're performing. If you have an in-house CFO, they will be doing that for you, and they'll probably tell you the areas that cause concern. If you don't have a CFO in-house, then generally this will sit with the founder, particularly with startups. The bookkeepers will do the P&L that I showed you originally. Your job then, if you don't have a CFO helping you, is to encourage them to do a P&L that looks like this, and encourage them to show you how the current month compares to the prior 2 months, prior year, same month, and budget. And you want them to compare it in pounds or dollars, or whatever currency you're working with, and percentages, because they both give you different insights. And then separately, you can look at your product margins. So there is a lot of information in a P&L if it is structured properly, and it can give you so many insights into what's working and what is not working. Okay, that was quite a lengthy video, and there was a lot of information there. So you may need to look at one section, work at that with your bookkeeper and finance team, and then go to the next section. Or you can just share this, or get your finance team to sign up to my weekly newsletter. But essentially, this kind of helps you think about how the P&L can help you. Because I know if you haven't had an introduction before to what a P&L can show you, and you just get a big lump of revenue, a big lump of cost of sales, and a lump of expenses in alphabetical order that haven't got any subtotals, like, how are you supposed to understand your business if you are getting that? You just can't. It's not going to tell you what you need to know to run your business properly. So you really need to get it structured properly so you can run your business properly and make the right commercial decisions. All right, I hope that was helpful. If you have any questions, I'm leaving loads of links below. And then next week, I'm going to go through balance sheet, which is a bit harder to understand, unfortunately. But, you don't have to look at your balance sheet as often. The P&L is, that operations to run your business, but the balance sheet also gives you a very good snapshot. But again, investors and banks and anyone that wants to give you debt or money will absolutely look at all three financial statements. So you need to understand what's going on in there. Okay, again, I hope that was useful and I'll see you next week. Cheers.